Dividend stock investors are interested in Coca-Cola because of its nice dividend yield. But is it a buying opportunity for 2026 and beyond? I'll answer that question in this video, and I'll reveal the biggest headwind Coca-Cola faces in the upcoming quarters and upcoming year.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So over the years, Coca-Cola has done an excellent job increasing its revenue. The company has demonstrated its pricing power as the increase in cost of goods sold due to inflation raised its production cost. It's passed along most of those increases in cost on to consumers through higher prices and changes in packaging sizes that increase the price per ounce, but do so in a clever way that's not noticeable or not as noticeable by consumers. The company's revenue has increased from 42 billion in 2016 up to 48 billion in the most recent trailing 12-month period. The biggest headwind Coca-Cola faces in the near term is decreasing traffic to restaurants. In 2025, people visited restaurants less than 95% of the levels they visit in 2024, meaning that restaurant visitation is down by roughly 5% year over year in 2025 compared to 2024. Those headwinds are likely to persist into 2026, as all of these price increases I'm talking about are not just happening with Coca-Cola, but restaurants worldwide, at least, well, I should say in the United States especially, have been increasing prices meaningfully. And so people are visiting less frequently. And when they are visiting restaurants, they're opting sometimes not to purchase beverages along with the meals that they're buying, as some restaurants, if you believe it or not, will charge you upwards of $5 for a cup so that you can fill it up with soda. And you can imagine how pricey that is, especially if you take out a family of four to a restaurant. If you're buying a beverage for each one of your family members, those totals start adding up meaningfully. So those headwinds are likely to persist in 2026, as I don't see any factors that are causing prices to go down. In fact, I see a lot of factors that will increase the prices at restaurants, including the mandates in California forcing restaurants to pay higher minimum wages to employees. That will result in higher prices for customers, which will result in less visitation to restaurants. And that's going to be a headwind for Coca-Cola in the near term. Longer term, of course, healthier choices by consumers are also weighing on Coca-Cola. The company is investing in more health conscious beverage options, but it doesn't have as robust a portfolio in those options as it does in the sugar, caffeinated, and carbonated beverage segment. That being said, Coca-Cola has done an excellent job controlling cost and improving returns on invested capital, which has increased from 9.7% in 2016 to 15.1% in the most recent trailing 12-month period. Now, when we look at the company's operating cash flow to sales ratio, you can see the declines from peak levels in 2021, where it soared to 32.7%. It fell all the way down to 14.5%, and thankfully is recovering back up to 16% in the most recent period. The company's cash flow to sales ratio is impacted by the company's large percentage fixed cost and global scale in international operations. The tariffs are also increasing pressure on Coca-Cola, increasing its cost of manufacturing, forcing the company to source more locally, and that's creating inefficiencies in its supply chain. Now, valuation is interesting for Coca-Cola. On a market multiples basis, it's trading at a forward PE of 22 and a forward price to OCF of 26, which makes the business look fairly valued given its headwinds and given its longer term trajectory. The company expects to grow revenue in the low single digits to mid single digits, meaning it'll probably grow its revenue between 2 and 6% for the foreseeable future. And given its cost structure, that should lead to earnings per share growth close to or approaching or exceeding the low double digits or high single digits, meaning between 8-9% earnings per share growth as high as 13-14% earnings per share growth, depending, of course, on the revenue growth rate. Now, when I calculated the company's fair value using my proprietary discounted cash flow model, I came to an intrinsic value per share of $89, which means that the company looks undervalued because it's selling at $70 per share. Even after applying a margin of safety, Coca-Cola stock looks undervalued. Also, I added a 25% increase in the company's risk, meaning the beta. I multiplied the beta by 1.25 to account for these near term headwinds the company faces. And even after applying that 25% increase to the company's beta, I still calculated an intrinsic value per share that's well above the company's current market price. So, to answer the question, do I think Coca Cola stock is a buying opportunity for 2026 and beyond? The answer is yes. Hey, if you value my process for researching stocks, I think you'll appreciate access to my spreadsheet containing my discounted cash flow valuations, which calculate a fair value for over 200 companies. It answers the question, what's a good price to pay for a certain stock? You can get access by joining our channel at the investor tier or above. See the link in the description or click the join button below to learn more.